Hello everyone. In this video, let's go over an example of the depreciation methods for property, plant, and equipment in Chapter 11. I'm using the example I gave you in the handouts from Tuesday's class. So this is a simple case. We have a equipment. We need to know the original cost is given directly here by the question. But in the actual business, as we learned from chapter 10, first you need to decide the correct cost component for the assets you are trying to depreciate. That may include the pricing, any discount or transportation, and other related fees to bring the assets to the desired location and the condition before you can use it. So first, make sure you have the idea about the true cost or we call the historical cost or the original cost. Then a estimated useful life or service life of the asset, again, is given by the question 5 years. In the real business, you need some estimation like your car, the housing equipment, because in the beginning we have the best estimate, but the situation may change later. We need to revise the service life. So this is a estimated base. Also, we need a estimated residual value, or sometimes they call salvage value for the assets. Means how much the remaining value for the assets when the company is ready to dispose the assets. Sometimes there is no value can be used after we finish the assets. So it can be zero or any other amount decided by the related asset management. So again, this is a estimated value. So overall, it doesn't matter which method you use, there are always estimation involved. So later that we have another topic address if we change the estimates later. Sometimes in a life, in a time point of the life, if we revise the useful life or the residual value or you change the depreciation method, that can initiate some other accounting treatment at that time. But now we are just assuming a simple case for this asset across all of the 5 years without any change of the estimates. For depreciation method, overall, we have two approach, allowed, you see this is the gap, principle or rules. The gap allows two different types of approach for depreciating physical or tangible assets, time-based or activity-based. The assumption under the time-based approach, like in most of the cases, so we use the assets constantly over the service life, right? So it's not really I use it for 2 months over the year, then you don't pay it for the rest of the time. So evenly used across the life, so we can adopt one of the approach under the time-based methods. But if you have seasonal operations like the oil industries, the mining system, or some natural resource industries, you may have uneven use of your equipment over time. Then in that case, you can consider the activity-based method. So let's go over the time-based first because those are the primary depreciation used commonly under different businesses. Under the time-based, we have a straight line average. So straight line, you already know from your prior accounting courses. So this basically means we average the cost of the assets over the useful life, what they call straight line approach. So even like, every year, every month, we are taking the same amount of depreciation. Normally, this amount we decided in the very beginning of the asset usage. So even like, very like equal average method. But with the technology continue to to develop over time, so we have lots of the tech or innovation related equipment like computers and high tech equipment. For those type of assets, the value decrease or reduce rapidly in the first few years or the early periods of the useful life. Maybe like after 2 years, like 80% of the value are already gone. So in that case, we consider the early depreciation and use the accelerated depreciation approach. So accelerated approach, we have two methods the companies can choose to use. So as compared to the straight line. So under time-based, okay, two approach, straight line or accelerated. And under accelerated, there are two choices for the companies to use. So let's go over the straight line. So it's like a review, not really, new calculations. So straight line approach, we are averaging the total cost of the assets over all of your depreciation period. So you can decide, okay, monthly, quarterly, annual, So I didn't really put yearly or annual or month, so I put like a period, right? So depending on the question or your situation, so however denominated by the period. And in this case, is annual depreciation. Under straight line depreciation, the depreciation rate, right? Like the portion of the depreciation each year is average. For us, is 5 years. So each year is taking a 20% of the value from the total assets. So 1/5. So 1 year over 5 years. If you do months, right? If you do monthly depreciation, you can use like 1 divided by 60. All of the months over 5 years, right? So depending on again on your the period you choose to do the calculations. So I'm doing yearly depreciation. So the depreciation rate will be the same for each of the years. I will put like a 0.2. Or if you use percentage, will be 20%. Okay, whatever. So you think maybe I can change this to percentage. Or if you want to use a fraction, that will be 1/5. Okay, whatever is indicating we are allocating the total cost of the equipment over 5 years of your useful life. And then, oh, I need to delete this. But we need to determine the original cost to be depreciated. Be careful, the depreciation cost may not necessarily equal to the original cost because of the residual values considered in each situations. So for us, the original cost is 162,000, but be careful, don't use it directly in your formula for the depreciation. We need to take the residual value from the original cost. So my base, okay, I'm putting here as a base. So I will do a calculation. So I put a formula. So I use the original cost minus the residual value. So it's 154,000 rather than 162. Okay, be careful. That's a common mistake I saw from all the prior teaching experience. So for straight line approach and sum of year digits, which we'll touch in a few moments, the depreciation cost equal to the original cost minus any residual value exist. Okay, that's your allocation or depreciation base. So after I have the depreciation base, or I can, if you think the book value, I will put it here. Okay, that's depreciation cost not necessarily equal to your original cost. So after I determine the depreciation cost and a constant rate, I can easily calculate the depreciation expense each period and then the accumulated depreciation. So what I'm going to do, put the formula directly. So the first year, so I'm using the prior depreciation, like the base for the first year, multiply by the rate of that year. So Excel in this part is very straightforward. Okay, so we can see all of the formulas and the columns, how these numbers are related. And the accumulated depreciation as in the first year will equal to the first year depreciation expense because we have no prior accumulated depreciation. Okay, that's only for the first year. And after the first year, the book value, all the remaining depreciation cost will be reduced by, I will use the prior balance, the minus the accumulated depreciation we already take. So book value is a amount we know we don't really have a ledger account, right? So in the financial accounting, we have equipment, we have accumulated depreciation, but the book value is the difference between these two accounts, but we don't have a direct ledger for that. But we can figure out the amount by looking over those two accounts. So first year again, annual depreciation, accumulated depreciation, and the remaining book value, the remaining depreciation cost. So that's the new depreciation base for the next year, okay, which is the second. So I will continue. This 38, this one actually I can use it. I just copy. Oh, I'm sorry. This is the formula. Okay, I will copy this number and paste. Isn't not letting me do it. Okay, let me see. Oh, because this one I use like a formula. Okay, I will just copy and paste as value. So it will not. So straight line, same depreciation. Now I work on the accumulated depreciation in the second year, so that will add up. And so I need to use the prior, this one, right? There are different ways you can figure out all of these numbers. Oh, plus the new depreciation we are adding in the second year. So accumulated depreciation will add up to the end of the service life. Okay, I will copy this. I can do. So 30 year add another 30,800 and the first year and the final year, the total depreciation, accumulated depreciation will equal to the original cost of your assets. So we are ready to dispose. You should have a zero book value by the end of the service life. And then I think this one I can continue copying my formula because each year you are using the prior depreciation balance, depreciation cost, minus the accumulated depreciation. I think, let me adjust this. For this one, I should have, if I use this one, okay, I should use the original cost minus the total depreciation and continues. There's some or I can use the original cost directly minus this one. So I can just copy and paste my formula for the rest of the year. And maybe I can make this consistent. So in terms of the formula, all the way you figure out there are different ways, but the result will be the same. Or it doesn't matter you use the original cost minus the accumulated depreciation, or you adjust the depreciation each year. The final table of your depreciation schedule should be the same. But there are multiple approach. We can do this as long as you understand, okay, the connections between the different columns. And eventually, after 5 years, the value of the assets, the book value becomes zero. And that's the time we can dispose it, like as you are planning. So there's no residual value. So if you try, I can like sell the assets or just dispose it with no residual value. That's your choice. But if you still can sell it, like, getting some value, and you can compare, like, you can maybe some gain or losses from the sales transactions. But in terms of the depreciation schedule on the straight line, so review, okay, for straight line, first determine your depreciation base. Is the original cost minus any salvage value. Then determine your depreciation rate, or is a average over the service life. Then annual depreciation or periodic depreciation should be equal from each other. And then accumulated depreciation should be built up year by year, period by period, and eventually the total depreciation should equal your book value, the original depreciation cost. The book value column should be decreasing the opposite trend as your annual or accumulated depreciation. Okay, it's decreasing by the annual depreciation expense and reach to zero when we finish. Okay, that's what about the straight line as an overview. After we really understand the columns, and it will be easier for us to do the other approach, like the accelerated.